I'm talking about the kind of contrarian information that makes you stop scrolling and check the tape twice. A few hours ago this morning, silver was sitting above $93 an ounce. Reddit was on fire. Twitter was screaming, "Silver Squeeze 2.0." The usual crowd was posting rocket emojis and predicting $100 silver by February. And then, quietly, violently, the floor started to crack. I've been stacking physical silver and analyzing commodities markets for 12 years, and I'm telling you right now, this isn't the setup the crowd thinks it is. Before we start, if you're curious who's behind this avatar, go have a look at the channel intro on my homepage. Now, let's get into it. While everyone was busy refreshing their COMEX inventory charts and watching YouTube channels pump the infinite deficit narrative, George Heppel at BMO Capital Markets issued a warning that should make every single person holding silver above $90 extremely uncomfortable. The title of his note? Dangerous Territory. I'm recording this just a couple hours after pulling his latest research, and the timing matters because what's happening right now this afternoon is the early tremor before the real move. Gold is up, silver is bleeding. The gold to silver ratio just punched through 52 to 1, and it's widening as we speak. The crowd thinks we're going to the moon. BMO says the floor is about to vanish, and the reason why has absolutely nothing to do with money printing, inflation, or any of the narratives you've been hearing. Here's my primary claim, and I need you to hear this clearly. Silver's current price above $90 is a speculative bubble that is completely detached from its hollowing industrial foundation in the solar sector. Let me say that again. The thing propping up the silver story, the solar revolution, is actively dismantling itself beneath your feet. Silver has tripled since early 2025. Gold has only doubled. That divergence pushed the gold to silver ratio into what I call the 50 to 1 trap. And if you don't understand what that means, you're about to get violently educated by the market. This isn't fear-mongering, this is math. In this video, I'm going to teach you the mean reversion mechanism that governs the gold-silver relationship. I'm going to walk you through BMO's surplus calculations line by line. And I'm going to show you the exact triggers that will make me personally rotate my own silver stack back into gold. Not because I hate silver, I've been stacking it for over a decade, but because I respect the math more than I respect the hype. You're here early. The data I'm showing you was published this morning. Most people won't see this for days, if ever. By the time the mainstream finance channels pick this up, the move will already be over. So let's get into it. Before we go any further, I need to teach you a concept that will save you more money than any to-the-moon prediction ever will. It's called mean reversion. If you don't understand this, you will lose money in this market. It's that simple. Here's the definition. Mean reversion is the mathematical law that prices and ratios eventually return to their long-term average. Think of it like a stretched rubber band. The further you pull it away from its resting state, the harder it snaps back. In the case of silver, the resting state is its historical relationship with gold. Over the long term, silver and gold maintain a relatively stable ratio. Sometimes it's 60 to 1, sometimes it's 80 to 1. The exact number shifts with industrial demand, monetary policy, and market conditions. But here's the key. When that ratio gets stretched too far in either direction without a fundamental reason to support it, the market forces it back. Right now, silver is what I call a fast follower. It follows gold's moves, but it moves faster and more violently in both directions. When gold rallies, silver rallies harder. When gold corrects, silver crashes harder. That's not a bug, that's the design. Let me give you an analogy that will make this click. Imagine gold and silver as two runners tethered together by a bungee cord. Gold is the steady, disciplined runner on solid ground. Silver is the faster, more volatile runner who just sprinted ahead onto a thin ledge of industrial hype. Right now, that bungee cord is stretched to maximum tension. Gold is at 48.31. Silver is at 92.87. The ratio is 52 to 1. That ledge silver is standing on, it's industrial demand, specifically solar demand, and that ledge is crumbling. Here's why this is a trap. In the last decade, every single time the gold to silver ratio hit 50 to 1 without a corresponding industrial boom to justify it, a sharp mean reversion followed. And by sharp, I mean silver crashed relative to gold. Not because silver went to zero, but because gold kept climbing while silver either stalled or fell. The ratio snapped back to 65 to 1, 70 to 1, sometimes higher. If you were holding silver during those windows, you watched your position bleed value while gold holders printed money. Now, I know what you're thinking, but this time is different. The world needs silver for the solar revolution. The deficit is real. The squeeze is happening. That's the exact narrative being used to keep you in the trade while the smart money exits. So let's go on the ground and look at what's actually happening right now. The real tape. Let me show you the market snapshot from a few hours ago this afternoon at 1:20 p.m. Eastern. Silver, $92.87, down $2.14. That's a 2.14% drop. Gold, 48, 31 and 53 cents, up $55.45. That's a 1.16% gain. Do you see the problem? Gold is rallying, silver is falling. The ratio, approximately 52 to 1, and it's widening. This is not the price action of a metal in a genuine supply squeeze. Now, if you're deep in the retail silver community, you're being told that exchange inventories are tight, you're being shown COMEX warehouse data, you're being told that physical premiums are spiking, and all of that might be true on the retail side. But here's what BMO's internal models are showing. The global physical surplus is actually increasing. Let me be clear about what that means. The surplus is total annual production minus total annual consumption. If production is 1 billion ounces and consumption is 950 million ounces, you have a 50 million ounce surplus. BMO's research shows that surplus is growing, not shrinking. Why? Because industrial buyers, the professionals who actually use silver in manufacturing, are stepping away from the $90 plus price point. They're not panic buying. They're not scrambling to secure supply. They're walking away. And when industrial buyers walk away, the only people left holding the bag at these prices are retail speculators. That's you. That's me. That's everyone watching YouTube videos about silver squeezes. The professionals are gone. Now, I know exactly what the pushback is going to be. I can already hear it. There's a massive physical deficit. The Silver Institute published a report. You're ignoring the data. Let's address that head on. The Silver Institute has been one of the primary sources feeding the silver shortage narrative. Their reports get cited everywhere. Reddit, Twitter, YouTube, financial blogs, everyone quotes them. And I'm not saying they're lying, but I am saying that BMO Capital Markets, one of the most respected institutional research houses in the commodities space, is directly challenging that narrative with hard data. BMO's research shows that total annual production minus consumption is shifting toward a surplus as solar companies actively reduce the amount of silver they use in their designs. This is called thrifting, and it's happening at scale. Here's the myth that needs to die. The idea that solar panels must use silver. That's not true. It never was. Silver is used in solar cells because it's an excellent conductor and it's been the industry standard for decades. But it's also expensive. Extremely expensive. At $90 an ounce, silver is the single most expensive component in a solar cell. So what do you think Chinese manufacturers, who control the majority of global solar production, are doing? They're engineering it out. Let me hit you with a rapid-fire breakdown of what's happening in Chinese solar tech right now. Copper-plated cells, heterojunction technology, or HJT, advanced screen printing techniques that use 50% less silver per cell. These aren't experimental lab projects. These are commercial products, shipping today. Chinese manufacturers have cracked the code on copper plating, which allows them to replace silver paste with a copper layer that's a fraction of the cost. HJT cells use even less silver than traditional PERC cells, and they're more efficient. The result? The amount of silver needed per gigawatt of solar capacity is collapsing. And this is where the silver squeeze narrative completely falls apart. If the solar industry, which represents roughly 20% of global silver demand, stops buying silver, who is left to support $90 prices, jewelry, industrial photography, electronics? None of those sectors can absorb the volume that solar was consuming. And if solar demand is falling, while production stays flat or even increases, you don't get a deficit. You get a surplus, which is exactly what BMO is seeing. Let's go deeper into the math, because this is where the story gets truly ugly for silver bulls. There are two forces converging on silver demand from the solar sector, and together they create what I call the solar double whammy. Force number one, the installation plateau. Major energy agencies, the International Energy Agency, Wood Mackenzie, and others, are reporting that global solar installations have peaked. Not slowed, peaked. Why? Grid bottlenecks in the US and Europe. Physical infrastructure can't absorb the power. Utilities are rejecting new connections because the grid wasn't designed for distributed solar at this scale. In China, it's market saturation. They've built so much solar capacity that they're hitting diminishing returns. Provinces are curtailing solar farms because there's no demand for the power. This isn't a temporary slowdown. This is a structural ceiling. Solar installations are not going to keep growing at the rate the silver bulls need them to grow. Force number two, aggressive thrifting. Even if installations stayed flat, which they're not, the amount of silver needed per panel is falling so fast that total silver demand from solar is already in decline. Let me give you the numbers. A few years ago, a standard solar cell used about 100 milligrams of silver. Today, Chinese HJT cells use closer to 50 milligrams. Some advanced designs are under 40. That's a 50% reduction in silver loading per cell. Now multiply that across billions of cells and you can see the problem. Even if the number of panels being produced stays exactly the same, the total volume of silver consumed drops by half. And here's the kicker. Panel production isn't staying the same. It's flattening or declining due to the installation plateau. So you have fewer panels being installed, and each panel uses half as much silver. That's the double whammy. The solar sector was supposed to be the industrial floor beneath silver, the thing that justified the price, but that floor just vanished. And let me recap where we are so far, because this is critical. We've seen the price disconnect, gold rallying, silver falling, ratio widening. We've learned mean reversion, the mathematical law that will force this ratio back to its historical average. We've debunked the infinite solar demand myth with hard data from BMO and Chinese solar manufacturers. Now let's talk about what happens next. The correction mechanism. BMO's forecast is very clear, and I want you to understand the mechanism they're describing. They expect the gold to silver ratio to be forced back up. That means one of two things happens. Either silver stalls, while gold continues to climb, which widens the ratio slowly, or silver crashes, while gold holds steady or climbs, which widens the ratio fast. Both scenarios are bad for silver holders, but the second scenario, the fast correction, is the one that will destroy portfolios. And here's what triggers it. This is something called the fast follower correction. Silver is a leveraged bet on gold. When gold rallies, silver rallies harder because speculators pile in looking for bigger percentage gains. But when the fundamentals beneath silver weaken, like they are right now with solar demand collapsing, that leverage flips. Silver doesn't just underperform gold. It crashes relative to gold. The speculators who bought silver for the momentum get flushed out. Stops get hit. Margin calls happen. And the selling accelerates. Now you might be thinking, okay, but this is all theoretical. What's the actual trigger that starts the selling? Great question. Watch for margin hikes on the COMEX. The CME group, which runs the COMEX futures exchange, has the authority to raise margin requirements on silver contracts if they believe the market is getting too speculative. And guess what happens when margin requirements go up? Retail speculators who are trading on leverage get forced to either post more capital or close their positions. Most of them can't post more capital, so they close. And when thousands of retail traders close long positions at the same time, the price collapses. This is not a conspiracy theory. This is exchange mechanics. It happened in 2011 when silver hit $49. The CME hiked margins 5 times in 9 days, and silver crashed 30% in a week. It can happen again. Let me give you the specific indicators I'm watching to know when the mean reversion has begun. Indicator number 1, the gold to silver ratio crossing 55 to 1. Right now, we're at 52 to 1. If that ratio pushes above 55, it's a technical signal that the snapback is accelerating. At that point, I'm tightening stops and preparing to rotate. Indicator number 2, mass shipments of copper HJT cells from Chinese manufacturers. This is the final nail in the industrial silver thesis. If we start seeing shipping data that shows copper-plated HJT cells flooding the global market, it means the silver thrifting process is no longer theoretical. It's operational at scale. And if that happens, solar demand for silver doesn't just decline, it collapses. I'm watching trade data, manufacturer announcements, and energy industry reports for confirmation of this. Indicator number 3, COMEX margin hikes. The moment the CME announces a margin increase on silver futures, the retail flush begins. That's not the time to hope for a bounce. That's the time to execute your exit plan. Now, most people will ride this all the way down. They'll hold their silver from $93 to $85 to $75 to $60, telling themselves it's just a correction and the squeeze is still coming. I've seen it happen before. I'll see it happen again. But you don't have to be one of those people. Let me tell you how I'm personally playing this. I want to be very clear about something. I am not selling all of my silver today. I've been stacking physical silver for 12 years. I believe in it as a long-term store of value and as a hedge against monetary instability. But I also believe in respecting the market. And right now, the market is telling me that silver is overbought, the industrial floor is crumbling, and the gold to silver ratio is stretched to a breaking point. So here's what I'm doing. I'm tightening my stops. If silver breaks below the $90 support level on high volume, I'm reducing my exposure. Not all of it, but a meaningful portion. And I'm rotating that capital into gold. Why? Because if the ratio is going to widen from 52 to 1 back up to 65 or 70 to 1, I want to be holding the asset that's going to outperform. That's gold. This isn't emotional, it's mathematical. If gold goes from 4,800 to 5,500 while silver stays flat at 90, the ratio widens to 61 to 1, and gold holders make 15% while silver holders make 0. If gold goes to 5,500 and silver drops to 75, the ratio goes to 73 to 1, and gold holders make 15%, while silver holders lose 17%. Do you see how this works? The ratio is the game. Now, let me show you why this setup looks so familiar. I pulled up the gold to silver ratio charts from the 1970s, and the pattern is almost identical to what we're seeing today. In the late 70s, silver ran from $5 to $50. In a parabolic move driven by the Hunt brothers squeeze and inflation fears, gold went from 200 to 850. The ratio compressed from 40 to 1 all the way down to 17 to 1. And then it snapped back. Silver crashed 80% over the next 2 years. Gold fell, but only 50%. The ratio went from 17 to 1 back up to 40 to 1. If you were holding silver, you got destroyed. If you were holding gold, you took a hit, but you survived. That's the lesson. When the ratio compresses too far without industrial fundamentals to support it, the reversion is brutal. And we are in that exact setup right now. I need to address the elephant in the room. There is a massive community of silver bulls who genuinely believe we are in the early stages of a historic short squeeze. They point to COMEX inventories, they point to delivery failures, they point to retail premiums. And I get it. I understand the appeal of that narrative. But here's what I've learned in 12 years of watching this market. The squeeze narrative only works if the underlying fundamentals support it. In 2021, there was a brief silver squeeze attempt driven by Reddit and Wall Street bets. Silver ran from $24 to $30 in a few days. And then it died. Why? Because there was no genuine supply shortage. The industrial demand wasn't there. The COMEX had plenty of physical metal, and the moment the momentum faded, the price collapsed back down. The same thing is happening now, except the starting price is $90 instead of $24. The risk is higher. The fall is steeper. The people pushing the squeeze narrative are either true believers who don't understand the fundamentals, or they're pumping their own bags and hoping to exit before the crowd does. Either way, you are the exit liquidity. I'm not saying this to be harsh. I'm saying it because I've been in this market long enough to see the pattern repeat. The professionals at BMO Capital Markets are not trying to squeeze silver. They're not trying to moon their portfolio. They're running institutional grade models on supply, demand, industrial consumption, and price dynamics, and those models are flashing red. If you choose to ignore that because you prefer the hopium of a squeeze narrative, that's your choice. But don't say you weren't warned. What the institutions are doing. Let me tell you what the smart money is doing right now, because it's the exact opposite of what retail is doing. Retail is buying silver above $90, posting on forums about the squeeze, and holding for $100 plus targets. Institutions are quietly rotating out of silver and into gold. How do I know? Because the price action tells me. Gold is rallying, silver is falling, the ratio is widening. That's not retail behavior. Retail doesn't have the capital to move the gold market like this. That's institutional flow. Big money is taking profits on silver, booking gains from the run-up, and reallocating into the more stable, fundamentally sound asset. They're not trying to time the top perfectly. They're not waiting for confirmation. They're executing now while there's still liquidity to exit. And when the institutions are done rotating, the retail holders will be left staring at a chart wondering what happened. This is how every speculative bubble ends. The early buyers make money. The institutions make money. The late-stage retail buyers get crushed. The only question is, which group are you in? There's a secondary angle to this story that almost nobody is talking about, and it ties directly into the broader metals complex. The grid bottlenecks I mentioned earlier, the infrastructure limits preventing solar installations from scaling, are not just a solar problem. They're a copper problem. They're an aluminum problem. They're a rare earths problem. The entire green energy transition thesis that has been driving commodity prices for the last 2 years is running into a hard wall of physical reality. You can build all the solar panels and wind turbines you want, but if the electrical grid can't handle the load, none of it matters. And upgrading the grid takes time, years, decades in some cases. Permitting, construction, utility coordination, political approval, it's a nightmare. In the US, there are solar farms sitting idle because they can't get grid connections. In Europe, the same thing. This isn't a silver-specific issue, but it directly impacts the industrial demand narrative that's been propping up silver's price. If the green energy transition is stalling, and it is, then the metals that were supposed to benefit from it are going to correct. Silver is just the first domino. Copper will be next, then lithium, then the rare earths. I've done a deep dive on copper and the electrical grid in a previous video, and if you want to understand the bigger picture of what's happening across the metals complex, you need to watch that. Because this isn't just about silver. This is about a fundamental reassessment of the demand assumptions that have driven this entire bull market in industrial commodities. And when those assumptions break, the corrections are fast and violent. I want to talk about the psychology of this trade for a minute because I think it's important. Silver has a cult-like following in certain corners of the internet. People don't just own silver, they identify with it. It's a political statement, a rebellion against central banks, a hedge against the system. And I get it, I really do. But that emotional attachment is what makes this trade so dangerous. When you're emotionally invested in a position, you stop thinking clearly, you ignore warning signs, you rationalize bad price action, you double down when you should be cutting losses. I've been there. I've held positions past the point of reason because I believed in the narrative more than I believed in the math. And I paid for it. The market doesn't care about your beliefs. It doesn't care about your conviction. It cares about supply, demand, and price. If you're holding silver above $90 because you believe in the squeeze, ask yourself this. What would it take for you to change your mind? If the answer is nothing, you're not investing, you're gambling, and the house always wins. The liquidity question. There's one more critical factor we need to discuss, and it's something that doesn't get enough attention in the silver community. Liquidity. When everyone is buying, liquidity is great. You can enter and exit positions easily. Spreads are tight, volume is high. But when the selling starts, liquidity evaporates, and silver is a much smaller market than gold. If institutional money decides to exit silver at scale, the bid side of the market disappears. You'll see massive spreads between bid and ask. You'll see flash crashes. You'll see quotes pull entirely. And if you're holding physical silver, good luck finding a buyer at spot price. Dealers will lowball you. Premiums work in reverse. You'll take a haircut just to get out. This is the reality of trading a smaller, more volatile market. When the music stops, there aren't enough chairs. I mentioned the 1970s earlier, but let me dig into that parallel a bit more because it's so relevant to today. In 1980, silver hit $50 an ounce. The Hunt brothers had been accumulating silver for years, trying to corner the market. Inflation was raging. The dollar was weak. The narrative was identical to today. Silver is real money, the system is broken, hyperinflation is coming. And then the COMEX changed the rules. They instituted Silver Rule 7, which banned new long positions and only allowed liquidation. The Hunt brothers couldn't roll their futures contracts. They were forced to sell. Silver crashed from $50 to $10 in a matter of months. 80% drawdown. Fortunes were wiped out overnight. Now, I'm not saying the COMEX is going to ban long positions in silver today, but I am saying that exchanges have the power to change the rules when they perceive systemic risk. And if silver keeps climbing on pure speculation with no industrial support, they will step in. They always do. Let me walk you through the actual mechanics of how I'm thinking about the ratio trade, because this is how professionals approach it. Right now, the gold to silver ratio is 52 to 1. That means 1 ounce of gold buys you 52 ounces of silver. If I believe the ratio is going to widen to 65 to 1, I can execute a ratio trade. I sell silver, buy gold, and wait for the ratio to revert. When it hits 65 to 1, I sell gold, buy silver back, and I end up with more ounces of silver than I started with. Let's run the math. I start with 100 ounces of silver at $90. That's $9,000. I sell the silver, buy gold at $4,800. I get 1.87 ounces of gold. The ratio widens to 65 to 1. Gold is now at 5,200. Silver is at 80. I sell my 1.87 ounces of gold for $9,724. I buy silver back at $80. I get 121.5 ounces. I started with 100 ounces. I ended with 121. That's a 21% gain in ounces, even though the dollar price of both metals moved against me. That's the power of the ratio trade. And it only works if you understand mean reversion and you have the discipline to execute. Most people won't do this. They'll hold their silver, watch the ratio widen, and lose purchasing power. But you don't have to be most people. The timing problem. Here's the hard part about this trade. Timing. I don't know exactly when the correction will start. It could start tomorrow. It could start next week. It could take another month. But I do know that the longer silver stays above $90 without industrial support, the more violent the correction will be when it comes. This is why I'm tightening stops instead of panic selling today. I'm giving the market room to prove me wrong. If silver breaks out above 95 and holds, I'll reassess. But if it breaks below 90 on volume, I'm out. That's the discipline. You set your rules ahead of time and you execute when the market hits your levels. No emotion, no second guessing. Now, there is one wild card in all of this that could change the equation: systemic financial risk. If we get a major banking crisis, a sovereign debt blow-up, or some other black swan event, all bets are off. In that scenario, both gold and silver could rally hard as safe haven assets, and the ratio could compress even further. I'm not predicting that. I'm not betting on that, but I'm aware of it. And if it happens, I'll adjust. That's the difference between being rigid and being disciplined. Rigid traders stick to their plan no matter what. Disciplined traders adapt when the facts change. Right now, the facts are solar demand is collapsing, the ratio is stretched, and BMO is warning of dangerous territory. If those facts change, my plan changes. Until then, I'm operating on the assumption that mean reversion is coming. I know this video is going to get hate. The silver community is passionate, and they don't like bearish takes. I'll be called a shill for the banks. A paper hands trader, a coward. I've heard it all before. But here's the thing. I don't care about being popular. I care about being right. And more importantly, I care about protecting my capital. I've been stacking silver for 12 years. I've lived through multiple cycles. I've seen the euphoria and the crashes. And I've learned that the market rewards patience, discipline, and respect for the math. Not hopium, not narratives, not belief. Math. So if you want to call me a bear, go ahead. But when the ratio widens and your silver stack loses 20% of its purchasing power while gold climbs, don't say you weren't warned. Let me give you the specific data points I'm watching over the next few days and weeks. First, the gold to silver ratio. I'm watching for a sustained move above 55-1. If we get there, the technical snapback has likely begun. Second, COMEX inventory reports. If we start seeing large withdrawals from professional accounts while retail accounts stay flat or grow, that's institutions exiting. Third, any announcements from the CME about margin requirements. That's the nuclear option that triggers the retail flush. Fourth, Chinese solar manufacturing data. If we see confirmation of mass copper HJT shipments, the industrial thesis is dead. Fifth, and this is broader, watch the copper price. Copper is the leading indicator for industrial demand. If copper starts rolling over, it confirms the grid bottleneck thesis and the broader slowdown in the green energy transition. All of this data is public. You can track it yourself. You don't need to take my word for it, but you do need to pay attention. Let me be fair and present the bull case, because I'm not here to just pump my own bias. If I'm wrong, here's what would have to happen. Solar installations would need to accelerate despite the grid bottlenecks. That would require massive infrastructure investment happening faster than anyone expects. Chinese manufacturers would need to abandon copper HJT technology and go back to silver-intensive designs. That would require silver prices to fall significantly, which contradicts the squeeze thesis. The COMEX would need to experience actual delivery failures at scale, forcing a true physical squeeze. That would require industrial buyers to come back into the market at 90-plus prices, which BMO says isn't happening. And the gold to silver ratio would need to compress below 45-1 and hold there for months, indicating a genuine paradigm shift in the relationship between the two metals. Could all of that happen? Technically, yes. Is it likely? No. But I'm watching for it. If the data changes, I'll change my position. That's what being a good trader means. The real risk. The real risk in this trade isn't that silver goes to zero. It's that you hold a depreciating asset while opportunity cost eats you alive. If silver goes from 90 to 70 while gold goes from 4,800 to 5,500, you didn't lose money in absolute terms. But you lost purchasing power. You lost opportunity. You lost the chance to compound your capital in a better asset. And in a bull market for hard assets, that's the worst outcome. You're in the game, but you're playing the wrong position. That's what most silver holders are going to experience over the next 6 months. They'll watch their stack hold its weight in ounces while gold holders get richer. And by the time they realize the mistake, the ratio will have already widened, and it'll be too late to rotate without taking a loss. Don't be that person. Here's where I stand as of this afternoon, January 21st, 2026. I am long silver, I am long gold. But I'm watching the gold to silver ratio like a hawk, and I am prepared to rotate. I'm not selling everything today, but I am tightening my stops to $90 on silver. If we break that level on volume, I'm reducing my silver exposure by 30 to 40% and rotating into gold. If the ratio crosses 55-1, I'm reducing another 20%. And if we get a COMEX margin hike or confirmation of mass copper HJT shipments, I'm out entirely. That's my plan. It's not advice. It's what I'm doing with my own capital. You have to make your own decisions based on your own risk tolerance and your own analysis. But I'm telling you right now, the math does not support silver at $90 without industrial demand, and industrial demand is collapsing. Let me zoom out for a second and talk about the bigger picture, because this is about more than just silver. We are in the middle of a historic bull market in hard assets. Gold, silver, copper, oil, agricultural commodities. Everything is rallying